Okay, so we started the diet uh, about 2 weeks ago. Today is going to be my third day class with you. All right. And of course, we started with the introduction to cost of capital for the benefit of those that are just joining us. All right. Then we started with introduction. We also discussed the importance of cost of capital. Thereafter, we move to categories of cost of capital. Of course, that's what we have been discussing from day one up to this moment. And today and the next week, possibly, we should be able to complete traditional weighted average cost of capital. Then thereafter, we then have project-specific cost of capital, and then weighted average cost of capital of the combined activities. So for the purpose of those that are just joining the class or that joined during the week, we said that cost of capital is the compensation required by the providers of capital from their investment in a firm. And then it is usually determined by the market forces of demand and supply, depending on the perceived risk associated with the business. Of course, there are other criteria, there are other determinants of a cost of capital. It's not just about demand and supply. However, when we are done discussing the introduction, we then move to importance of cost of capital. And we said that the equivalent using relevant investment appraiser technique like NPV, internal rate of return, project duration, right? Modified internal rate of return or adjusted present value, all right? We also said that the second significance of cost of capital is determining debt equity proportion. We said cost of capital will be required to determine the debt equity proportion, the mix of capital. So it will enable a company to ascertain what percentage of equity and debt to be carried in the capital structure in order to minimize the overall cost of capital. Of course, those are the two significance of cost of capital that I mentioned to you last time. Of course, there are more than that. For example, we also have our cost of capital is also useful for performance evaluation. You know, for those of you that did skills level, you did performance management, you must have been taught divisional performance evaluation. All right. And you know that there are several methods of determining, of appraising a manager within an organization. We have residual income. We also have a return on capital employed. So as far as cost of capital is concerned, when you want to measure the performance of a company, of management, of a firm, right? So provided the return on capital employed is higher than the cost of capital, it means that the company is able to create value, all right, to enhance the shareholders' wealth. You recall in our first day class, I also mentioned that company must generate sufficient return over and above its cost in order to create value. So provided a company is able to earn profit, it means that the company has been able to create value, because it is from the profit you are going to pay dividend to the shareholders. So at all time, the major responsibility of any responsible management of a company is to create value for the business in order to increase the shareholders' equity value. Okay, so like I mentioned, provided the return on capital employed is greater than the cost of capital, it means that the company has been able to create value for the owners. Then you can also add as one of the significant or usefulness or importance of cost of capital, which is valuation, all right? So when you are valuing a company, cost of capital will be needed to discount the free cash flow, All right. So you are going to need cost of capital to discount the free cash flow when you are carrying out valuation, even though there are different methods of valuation, but the most sophisticated method is the discounted cash flow method, whereby it's a method that relies heavily on the use of of course, when we get to valuation, you'll be seeing, you understand better when we get there. So these are some of the of capital. The number 3, weighted average of capital of combined activity. And we said that traditional when mention about capital structure, that is preference share capital and debt capital. Not only that, if in the question you have information about dividend, okay, you have information about interest, then it means that you are supposed to calculate WACC using the traditional method. We then proceeded to discuss the procedures involved in calculating WACC using the traditional method. We said the first procedure is to calculate cost of equity. All right. Step 2, you calculate cost of preference share. Then step 3, you calculate cost of debt. Step 4, you estimate weighted average cost of capital. These are the procedures involved anytime you want to calculate traditional WACC. Okay, anytime you want to calculate traditional WACC, these are the steps that you are supposed to carry out. We then started with the first step, which is to estimate cost of equity. And we said cost of equity is the compensation or is the minimum required rate of return expected by the ordinary shareholders from their investment in the firm. Okay, and we said there are basically 3 methods of calculating cost of equity. The first one is dividend valuation model. The number 2 method is capital asset pricing model. The number 3, Miller and Modigliani. Of course, the Miller and Modigliani formula will be used when we get to adjusted present value. Then, of course, the capital asset pricing model is a bonus topic, is within the scope of our discussion for this diet. So when we get there, you will be seeing it in details. So our focus is on dividend valuation model. And we said that dividend valuation model is used to calculate cost of equity when information about dividend and share price are given in a question, and it is computed as the ratio of dividend to ex-dividend share price, depending on whether or not there's growth in dividend payments. So I provided you 2 different formulas that you can use, depending on whether you are given growth rates or whether dividend will remain constant to perpetuity. Okay, then of course, we then discuss the concept of cum div and ex div share price. Okay, and we said that the cum div share price is the share price that includes dividend. So when you are calculating cost of equity, you don't use cum div share price. So if in a question you are told that dividend is outstanding, dividend is about to be paid, or dividend will be paid, provided dividend has not been paid, it means that the share price given to you is cum div. So you need to convert it to ex div share price. And we said ex div share price is the share price that excludes dividend, okay? And it is the share price that must be used for the calculation of cost of equity. So if you are given a cum div share price, or if you can see in the question that dividend has not been paid, the most important thing you need to do before you begin to calculate your cost of equity is to deduct the current dividend from the ex-dividend share price. So that will give you from the cum div share price. So that will give you the ex-dividend share price. Then, finally, under cost of equity, we then discuss how to estimate growth rates. And we said that growth rate can be estimated using 2 different methods. The first method is to use the historical pattern of dividend payment, also known as averaging method. And the second method is to use the Gordon growth model. The first one, which is historical pattern of dividend payments, we said that the historical pattern of dividend payment is used when information about dividend payments when the history of dividend payments are given in the question, then it means, and you want to calculate growth rate, so it means that you have to use the averaging method or historical pattern of dividend payment or compound annual growth rates. Okay, whichever name you want to call it is the same thing. Then, of course, there are two different formulas which are provided that you can use to estimate the growth rate using the averaging method. Then we also discuss the Gordon growth model, and we said that Gordon growth model is used to calculate to calculate growth rates when information about earnings and capital employed are given. Okay, I demonstrated what you should look out for you to be able to calculate your growth rates using the Gordon growth model. So thereafter, in our second day lecture, which was last week, we then discussed preference share, cost of preference share. We said that preference share is the compensation, the cost of preference share is the compensation required by the providers of preference share capital from their investments in a firm, and that the preference shareholders are entitled to fixed dividend, and they must be paid before the ordinary shareholders are paid. Basically, we have cumulative, non-cumulative preference share, participating or non-participating preference share, redeemable or irredeemable preference share. We focused on the one that involved calculation, which is redeemable and irredeemable. We said irredeemable preference share is the one in which the company is expected to pay annual fixed dividend, but the principal will not be repaid. And the cost of irredeemable preference share is computed as the ratio of fixed dividend to ex-dividend share price. Okay, we then proceeded to discuss the cost of redeemable preference share. We said redeemable preference share is the one in which the company will pay annual fixed dividend and the principal at the maturity date. All right, and then of course the cost of redeemable preference share is computed as internal rate of return. Anytime you want to estimate cost of redeemable preference share, just go ahead and calculate internal rate of return, and it involves two steps. The first step is to assume two discount rate that will produce two opposing NPV. Then step two, you then calculate the cost of redeemable preference share using internal rate of return formula. Not only that, we also mentioned that redeemable preference share, we said that preference share can be redeemed at par, at premium, or at a discount, and that the par value of preference share is always quoted at 1 naira. So what that means is that if the preference share is quoted at a premium, it means that it will be higher than 1 naira. If it's at a discount, it will be lower than 1 naira. Of course, since the par value is 1 naira, so that's that. Then finally, we also discussed last week cost of debts. Okay, we discussed cost of debt, and we said that cost of debts is the compensation required by the providers of debt capital. All right, and the debt holders are entitled to fixed interest, and that in the event of liquidation, the debt holders must be settled before the preference shareholders and the debt holders are paid. Okay, basically, we said that debts can be redeemable or irredeemable, callable or non-callable. Of course, our discussion was around redeemable and then irredeemable, because those are the ones where you are going to have calculations. Not only that, we also mentioned that debt is a cheaper source of financing because of tax deductibility benefits. If a company finances its operation with debt, the cost that the company will pay to the investor will be lower because of tax relief or tax benefit. All right, then we discuss irredeemable debt. We said irredeemable debt is the one in which the company will pay annual fixed interest, but the principal will not be repaid. Every year till perpetuity, the company will be paying annual fixed interest. but the capital contributed by the investor, by the providers of debt capital, will never be repaid. The company will not pay it back to them. Okay? And we said that the cost of irredeemable debt is computed as the ratio of fixed interest to X interest price, depending on whether or not there is tax. Okay? So I also gave you two different formulas that you can use to estimate the cost of irredeemable debt. Then the second one, which is redeemable debt. We said that redeemable debt is the one in which the company will pay annual fixed interest and the principal at the redemption date or maturity date. And we also mentioned that debt can be redeemed at par, at premium, or at a discount. The par value of debt is always quoted at 100 naira unless otherwise stated. Oftentimes, examiner can tell the student that, okay, the bond is quoted at 1,000 naira per unit. So if the debt is quoted at 1,000 naira, then that's what you should use. But in most cases, it is 100 naira. So where examiner is silent, you are not told whether it is 100 naira or 1,000. So you have to assume it is 100 naira. So we then proceeded to calculate the cost of redeemable debts. We said redeemable debt cost of redeemable debts is calculated as internal rate of return, just like you have the cost of redeemable preference share. It's the same thing. The only thing that will change is the cash flow. So anytime you want to estimate cost of redeemable debt, just go ahead and calculate internal rate of return, okay, by assuming two discount rate that will produce a positive and negative NPV. Then you calculate cost of redeemable debt using internal rate of return formula. It's as simple as that. We also discussed market value, how to estimate market value of a preference share, market value of debt, and all of that. So this is where we stopped in our last class. So today we are going to be discussing cost of convertible securities. We are going to be discussing cost of convertible securities. So this is where we stopped in our last class. Okay, so let's have a fresh page where we are going to be discussing cost of convertible securities. So what do you mean by convertible? Let me see. All right, so let's move on. So what do you mean by convertible securities? Before we begin to talk on, let me just give you an intro, a kind of intro. You know, when you talk about convertible, what we are saying is that they are that kind of securities that we usually have that the investor can convert to ordinary share capital at a later future date. Any securities that can be converted to ordinary share capital, they are the convertibles. They are the convertibles. And so you want to estimate the cost of that convertibles. All right. So that is the essence of what we are doing. Examiner can ask you to calculate the cost of convertible debenture, convertible bond, convertible preference share. Examiner can ask you to determine market value of convertible securities. So you must know how to do them. All right. So what do you then understand by cost of convertible? First thing first, convertible security. Convertible security. Let me remove the. You have to stop going out and coming in because the person that set up the meeting has used the waiting. Forget to remove waiting room, so I can't be taking class. Then I'll be admitting people. So you have to stay.
Make
You
me
have to stay
okay,
to the
sir.
end. Okay. So let me even check that once and for God's power. Where are you? Sorry, fortune. Let me increase this. Promise. Okay. So promise you'll be adding them Whoever that wants to join, just add them. All right?
All right, sir.
You admitted them. Okay, so convertible securities are fixed income securities, including preference share, okay, including preference shares, bonds, debenture, okay, debentures, or loan notes that can be converted, to a known number of ordinary shares. Okay, to a known number of ordinary shares at a specified future date. Okay, so this security we just mentioned, preference share, bonds, debenture, or no notes, they have the attribute of convertibility. All right, of course, it will be in the prospectus, it will be in the indenture, right? So the indenture will specify the futures of the securities. So from the beginning, there will be a kind of that condition will be there. That's okay. If at this by so at so next 3 year, 4 year, 5 years, so you can convert to ordinary shares. All right. So that is convertible security. However, it should be noted that investor will only convert to ordinary shares only if it is profitable. All right. If it is not profitable, investor will not convert. They will just allow the security to mature, and then they will redeem it. That's what they are going to do. All right. So if the security is not attractive, they are not going to convert it to ordinary share. And one of the reasons why some of these securities are converted to ordinary share is because of the potential growth in the business. If there is future for the business, if there is likelihood that the company is going to will grow, has that kind of potential, then investors will be willing to convert their securities into ordinary share capital. All right. So, but that's one of the reasons why the cost associated with convertible securities are usually redeemable debts. Okay. That investors will only convert. Sorry about that. Let me reshare. It's my network. Okay. So like I was saying, investor will only convert to ordinary shares if it is profitable. Okay, we only convert to ordinary shares if it is profitable. So that is if the conversion value is greater or higher than the redemption value. All right. Otherwise, the investor will just allow the security to mature and then redeemed, and then redeemed. Okay. At the maturity dates. Okay, so that's what the investor will do. So if it is not attractive, if the offer is not attractive, maturity. If the offer is not attractive, they will never exercise their rights. Okay? They will never exercise their rights. All right. So what do you then understand by the cost of convertible securities? Calculating cost of convertibles. All right. How do you estimate cost of convertibles? So the cost of convertibles is calculated as internal rate of return. The same way you calculate cost of redeemable preference share or redeemable debt is the same thing. It's the same way you are going to calculate the cost of convertible securities. The only thing that will change is the cash flow. That's all. Okay, so how do you then calculate the cost of convertible security? The cost of convertible, this is calculated as internal rate of return. This is calculated as internal rate of return. Okay, using the following. Okay, let me put it this way. The formula below, or the steps, the following steps should be carried out when calculating the costs of convertibles. Okay, so what are the steps? Step 1, you assume 2 discount rates. You assume 2 discount rates that will produce a positive and negative NPV. Then step 2, calculate cost of convertibles. Cost of convertibles. That's all. Using internal rate of return formula. That's all you need to do. The same formula we use under cost of redeemable preference share and redeemable debts. It's the same thing you are going to use. Okay? So that's that. This is how to, however, when calculating the cost of, when calculating the cost of convertible, the higher of, okay, the higher of, let me bold it. Number 1, redemption value, or 2, let me use I, then 2, conversion value should be selected. So anytime you want to calculate cost of convertible securities, you are supposed to calculate internal rate of return. However, in doing that, the same way that you normally do when you are calculating cost of redeemable debenture, redeemable bonds, or redeemable preference share. The same way you normally calculate your NPV. The only difference is that when you are calculating cost of redeemable in the final year, at the maturity date, you normally use the conversion or redemption value. So in this case, instead of using redemption value, you are going to use the conversion value only if conversion value is higher than the redemption value. So at all time that you want to calculate the cost of convertible security, you have to compare and select the higher of redemption value and then conversion value. That is the uniqueness of convertibles. All right. So that's what you are going to do. So finally, another key thing you need to know is how to estimate market value of convertibles. So calculating market value of convertible securities. So how do you estimate the market value of convertible securities? The market value of convertible securities represent the present value of future cash flows. What are the future cash flows? They are in two forms. The first one is fixed dividend, if it is preference share, or fixed interest, if it is bond, debenture, or loan note, and then the principal repayment or the conversion value. Okay, so anytime you want to compute the market value of convertible securities, just go ahead and calculate present value. Okay, so that's why we said that the market value of convertible represents the present value of future cash flows. That is the fixed interest or fixed dividend, and then the conversion value discounted at the yield or rate of return on the security, all right, or rate of return on the convertible. So that's what you need to do. It's very straightforward, all right? Don't let that examiner create phrase in your mind or in your heart. Okay, go and calculate, determine cost of convertible, then you start looking like started doing UYY. No, don't allow ICAN or examiner to scare you with grammar. It's not difficult. You can see what I've been saying since last week in relation to redeemable preference share, redeemable debt, convertible. They are the same thing. The only thing that will change is the cash flow. So let me just put it down for you. This represents all right. This represents the present value of future cash flows. So what are the future cash flows? I've told you there are just two. All right. That is fixed dividend. That is if it is preference share, or interest or fixed interest, and conversion value. Then you close the brackets. Discounted at the yield. Discounted at the yield. Yield is the same thing as internal rate of return, or you call it yield to maturity. Okay, discounted at the yield or rate of return on the convertible security. Okay, so that's that. This is how to calculate the market value of convertible security. The formula below, or the table below, can be used to calculate the market value of convertibles. So let me copy what we have done before. I've told you already, it's the same thing. Anytime you want to calculate market value, be it redeemable, preference share, or redeemable debt, or convertible securities, it's the same thing. All right. Let me use the same color. What's wrong with you? Blue. Oh, I did not ask you to do that for me. Blue. This is the one I wanted to use. Okay. So in this case, I will not do anything here. I will not put any value here. The first thing I will do when I'm calculating the market value of convertible securities, after designing my table like this, all right, if it is preference share, here will be fixed dividend. If it is debt, if it is the debt, either bond, debenture, or loan note, of course, it will be interest because there are two cash flows associated with convertible securities: fixed dividend or fixed interest, as well as the conversion value. So those are the two cash flows. So when I now get to the exercise date, the exercise date is when the investor will convert to ordinary shares as agreed. So on this exercise date, I need to go and check. I need to go and do my workings and compare the higher of redemption value, or conversion value. Any of the two that is higher is the one that will come here. So in this our format, we're assuming that this will be a conversion value. So this one will be conversion. So that's that. Of course, the coupon rates or the amount, the nominal rate of the convertible preference share, as the case may be, will surely be given to you. All relevant information will be there in the question. So just multiply the cash flow with the discount factor to get your present value. You add up all the present value, so it will give you the market value. And that's why we said that the market value of convertible is calculated as the present value of future cash flows discounted at the yield or rate of return on the convertibles. All right. So this yield, the yield will surely be given to you in the question. If it is not given to you, then you need to go and calculate internal rate of return. So it's as simple as that. Just go ahead and calculate internal rate of return to get the yield or rate of return on this convertible. So then multiply the discount factor or annuity factor. You multiply with the cash flow to get the present value. You add up the present value. So whatever you have as the total, that represents the market value. This is what you need to do. All right. So let me just, as an additional comment, also the higher of one redemption value or two conversion value should be selected when calculating the market value of the convertibles. So that's all you need to do. It's not more than this. No matter how big is the question, it's the same thing. So it's not more than this. So that is that as per convertibles. So let's have short example just to demonstrate how to calculate cost of once we are discussing of capital. So we are going to finish all the underlying. Our next class, we'll just be solving. Let me push this one to the. Okay. Let me see. I need one of you to read for us. So for us, who is going to help us to read the question?
Me.
Yes, Felicia, go ahead. Thank you.
Lacazette
Lacazette
PLC.
PLC.
Lacazette PLC has in issue a convertible debenture with a coupon rate of 12%. Each 100 naira unit may be converted to 20 ordinary shares at any time until the expiry date. Any debenture will be deemed at 100 naira. The debenture has investor will normally require a rate of return of 8% per annum on the 5-year debt securities. Should the investor pass if the current share price is A 4 naira, B 5 naira, C 6 naira?
All right, and thank you very much, Felicia. That is the question. You have to be very careful. All right. Don't let the. You have to know what you are doing. At all time, your approach to a question usually will be determined by the requirement of the question. So in this particular question, examiner is asking you, should the investor convert if share price is 4 naira, 5 naira, or 6 naira? Remember earlier I mentioned that investor will only convert to ordinary shares if it is profitable. If it is not profitable, investor will just allow the security to lapse. They will allow the security to mature and then they will redeem it. So if the security is not, if the conversion is not attractive, they will never exercise their rights. So examiner is specific in this requirement that you should advise if investor should convert. Therefore, what are you supposed to do? Very simple. Just compare the conversion value with the redemption value. So you need to determine what is in this particular question. You have 2 steps to take or 3 steps. Step 1 is to calculate the current market value. If this debenture is going to be redeemed, okay, you calculate current market value if the debenture is going to be redeemed. And how are you going to redeem it? It will be at par because the examiner has given you 100 naira per unit. All right. So you keep it on one side. Step 2, you then calculate conversion value at 4 naira, at 5 naira, at 6 naira. Conversion value is calculated as the number of ordinary shares you want to convert multiplied by the market price of the ordinary share at the conversion date, at the exercise date. Okay. So at any price among these 3 share price, at any price that the conversion value is higher than the current market value, that is the price that investor should convert. So this is what examiner is asking you to do in this particular question. Therefore, quickly, let's go through the question together. Solution. The name of the company is Lacazette PLC. What are we asked to do? Examiner is asking you to advise if investor should convert. So, you know that for you to be able to advise, you know that investor will only convert if it is profitable. If it is not profitable, they will not convert. So how will you know it is profitable? First thing first, you calculate your redemption value, the market value the current market value. If the debenture is going to be redeemed, then step 2 is to then calculate the conversion value at each price. So number 1, so I need to calculate. I will say calculating current market value of redeemable debenture. So you are calculating the market value as if the debenture will be redeemed. All right. So what do you do? If you want to do this, remember, you want to calculate market value. And we said that market value of redeemable debts is the present value of future cash flows discounted at the yield. All right, it's the same thing. So discounted at the yield. Therefore, I will then come here. I want to calculate the market value. I will then go back to the question. Okay, let me remove all of this. All right, so I need to go back to the question and check what's the exercise dates. As far as the question is concerned, we are told that La Cassette PLC has in issue a convertible debenture with a coupon rate of 12%. So the interest rate on the debenture is 12%. So in that case, that means I'm going to have the first cash flow will be fixed interest. Okay, so this interest we are told is 12% of 100 naira. Remember, debt is always quoted at 100 naira per unit. So 12% of 100 naira will give us 12 naira. However, I need to check from the question if I'm given tax rates. Because if I'm given tax rates, I can't use the 12% directly like that. I need to adjust for tax. I need to calculate post-tax or after-tax interest. But in this particular question, we are not given tax rates. Therefore, we are going to use 12% like that. Just come in and put 12. Don't put percentage. Don't go and be writing 0.12. If you do that, you are going to make mistake. So just put 12 because it is 12% of 100 naira. And that's what I told you last time. Always forget the percentage. Just put the number directly, the absolute number like that. So that's that. Then I need to go back to the question again and check. What is the maturity date of this debenture? All right. When is the investor goes to exercise the right? Examiner has told us that the debenture will run for 5 years. It will take the debenture to run for the next 5 years. So the maturity date or the exercise date is in 5 years' time. Therefore, this interest that we want to calculate the present value will run from year 1. The company will pay interest from year 1 up to year 5. Okay, so in this case, I will then go back to the question again. For my discount factor, remember, we said that the market value of the market value of redeemable debt is the present value of future cash flows. That is the interest and the redemption value discounted at the yield or rate of return on the debt. So I will then go back to the question. Am I given the yield? Yes, examiner has told us in the question, we are told that investor will normally require a rate of return of 8% per annum on the 5 years debt securities. So what this simply means is that our internal rate of return, according to the question, is 8%. So I then need to calculate the annuity factor. All right, I need to calculate annuity factor of year 1 to 5 at 8%. Can somebody give it to me? What's the annuity factor of year 1 to 5 at 8%? Yes. Have you calculated it, or let me just demonstrate it? Working.
3.9927.
3.993, right?
Yes.
3.993. So just for the benefit of those, maybe if you jump fence, for those of you that jump fence, those that are coming from course, you have to stay in the class. If you go out again, I will not admit you. I've already said it. The person that set up the meeting did not uh, remove a waiting room. So I can't be talking and be admitting people at the same time. So you have to stay in one place. Otherwise, you just be hanging, you won't be able to join. All right. So for the benefit of those that join points, Faith, you are writing on my screen. Stop it. Let me stop sharing and share again. Otherwise, the line that the Faith has created will be there. Okay. So let me just calculate this for the benefit of those that may not understand how to calculate annuity factor. So annuity factor. So annuity factor, or what is also called a cumulative discount factor, is calculated when you have constant cash inflow. Anytime you have a constant cash inflow, that is when you calculate annuity factor. So in this case, like we have, what's wrong with you? Like we have here, the interest of 12 naira will remain constant for the next 5 years. So instead of you to be doing it one by one, so you need to calculate annuity factor. So in this case, I would then say annuity factor equal to, let me see, brackets first, brackets, and this, no, that's not what I want before. Garage. One minute. Let me start with brackets. Then this. I hope it will allow me again. I know. I know it will not. Let me just do it. Okay. Let me start with this guy here. Then this. Then brackets. Okay, let me leave it at this. So this guy, let's copy this one. 1 minute, please. Change your voice. Okay. Yes, that is what I want. All right. So the formula for annuity factor is calculated as 1 minus, okay. Of course, we then create, let me just use this one. Let me remove this brackets here. What's wrong with you now? 1, okay, minus. All right. 1 minus 1 plus r raised to power minus n raised to power minus n. We're supposed to, this power is supposed to come later. Let me just put it there because of time. I will correct it later on. Then divided by r. Okay. So this power is supposed to be for the two of them. Let's see. This happens. I want to, let me see if I create these brackets. Well, because of time, let's move on. All right, so you then say annuity factor equal to, you already know what I wanted to do, so I will correct it later after the class. Let me just move on. So 1 plus we are assuming 10%, sorry, we are given 8% rate of return. So 1 plus 8% will give us 1.08. So this should be 1.08 raised to power minus 5. Oh, I've removed that. (1.08) raised to power minus 5. Okay. Then divided by 0.08. All right. So from your calculator, this, remember, like I said, I will correct this later on because of time. So this minus 5 is outside the brackets. But for the purpose of this class, just so that we don't, I don't start doing trial and error, let me just move on. So you then bring out your calculator to get the final answer. All right. So this will be equal to, we are going to start from the parentheses, which is 1.08. All right. Then raised to power minus 5. Okay. Equal to, then just press minus 1. Equal to, then divided by 0.08. 0.08. So that will give us 3.9927. So when you round it, that will be 3.97, 3.993. Okay, so that's how Promise got the number the other time. Yes, Felicia, talk to me.
Yes, sir. I wanted to ask because this one that you brought outside is the one meant to be outside because mine, the one is the one and minus one plus r raised to power minus a. Both of them are numerators. For me,
No,
that's how.
no, it's only the R that is the denominator. All of this one, the one you are seeing here, there is a numerator. So only this R is the denominator. Like I said, I'm going to redraw, I'm going to pull the proper formula later on. All right.
Okay,
So
all
only
right.
the R is the denominator. Every other one there are
Numerator.
numerator, yes.
All right.
So 12 multiplied by 3.993. What do we have as present value? What do we have? So
47.91.
47 points.
9125.
So,
92.
so approximately is 48. All right. Then, of course, in the final year, which is year 5, the venture, the investors can either convert to ordinary shares or they will allow the security to lapse and then redeem it. So at this point, you are not going to write anything in this year 5 under items. You are not going to write anything. You need to first of all go and determine the higher of the redemption value and also the conversion value. Okay, we are even doing the we are doing redeemable. Okay, so I will then come here redeemable or redemption value rather. Redemption value. So we are told it will be redeemed at par. At par means 100 naira. So you then come here 100 naira. Then you calculate discount factor for year 5 at 8%. 1.08 raised to power minus 5. What do you have there?
0.681.
0.681. Thank you. 0.681. So that's that. Then you multiply with 100. This will give you 68. So 68 plus 48, that's 116 naira. Therefore, the current market value of this redeemable debenture is 116 naira. Okay, the current market value of the redeemable debenture is 116 naira. This is the price you are going to compare with the conversion value. Okay, so the step 2 you are going to do now is to calculate the conversion value. So I will then come here, conversion, calculating conversion value. Okay. How do you determine the conversion value? Examiner has already told you what you need to do. So to get the conversion value, simply go ahead and then multiply. Okay, you go ahead and multiply the number of ordinary shares you want to convert to. You multiply with the market price. You multiply with the market price. That's all you need to do. It's as simple as that. So the first item here will be number of shares. Then the second column will be the share price as given to you. Then the third column will then be the conversion value. Okay. So how many shares you want to convert to? 20 ordinary shares. We are told that each 100 units may be converted to 20 ordinary shares at any time until the expiry date. So we have 20 ordinary shares. So here is 20, 20, then 20. Then what's the share price? Share price of 4 naira, 5 naira, and then 6 naira. So to get the conversion value, you multiply the number of shares with the share price. So here will be 80 naira, followed by 100 naira, and then 120 naira. That's all. At this point, you then need to make a decision. You need to advise. Okay, you need to advise. Because examiner is asking you, should investor convert if the share price is 4 naira, 5 naira, and or 6 naira? So, and I told you that investor will only convert if it is profitable. If it is not profitable, they will not convert. So you need to compare the current market value of 116 naira. If this debenture is going to be redeemed, we compare it with the conversion value of 80 naira, 100 naira, and also 120 naira. So we see that the conversion value of 80 naira and 100 naira is lower than the current market value of 116 naira. Therefore, it is not attractive. Investors will not convert at 4 naira and 5 naira. But because conversion value of 120 naira is higher than the current market value of 116 naira, then it means that investors should convert at 6 naira. That's all. So I will come here, advice. Investors or investor should not convert to ordinary shares at 4 naira and 5 naira per share, since the conversion value of 80 naira and 100 naira are lower than the current market value of the debenture of the redeemable debenture. Okay. However, investor should convert at the share price of 6 naira because the conversion value at that price is higher than the current market value. Current market value. Okay. Per unit of the debenture. Per unit of the debenture. That's it. This is what the examiner is asking you to do. It's as simple as that. All right. So let's have one more illustration on the example on this, on how to calculate cost of convertible. Yeah, thank you, Toluwani. The numbers. I'm just reading your charts. So let's have one more on this. Let's have this example number 2. Okay. Yes, who is going to help us to read it? Example number 2.
Singapore.
Okay, thank you.
Singapore Limited has 10% convertible debentures with a current market value of 106 naira. An interest payment was made recently. The debenture will be converted to equity shares in 4 years' time at the rate of 40 shares of debenture. The shares are expected to have a market value of 3.5 naira each as that time. What is the cost of capital to the company for the convertible debentures when company tax rate is 40%, and assume that the tax payment occurs in the same year that the interest payment arises?
All right, thank you. So the requirements, you can mute now. You can mute.
I already have a question.
You can mute, Felicia. Now, the requirement says that you should calculate cost of capital to the company for the convertible debenture. You want to calculate cost of capital. You want to calculate cost of convertible debenture. So at this point, what are you supposed to do? Very simple. Just go ahead and calculate internal rate of return. That's all you need to do. So how do you then do this? Come here, solution. The name of the company is Singapore. Singapore Limited. What are you asked to do? You have to calculate cost of convertible. You then say calculating cost of convertible debenture. All right. So that's that. Let me copy. Anytime you want to calculate cost of convertible, what are you supposed to do? 2 steps. The first step is to assume two discount rates that will produce two opposing NPV. Then step 2, you calculate cost of convertible security using the internal rate of return formula. That's all you need to do. Okay. All right. So I will then go back to the question to go and check. What am I given? Okay, what's the exercise date for this convertible debenture? According to the question, you are told that Singapore Limited has 10% convertible debenture. So the 10% is the coupon rate, is the interest rate on the convertible securities with a current market value of 106 naira. So remember, the first step is to assume two discount rate that will produce two opposing NPV. When you are calculating internal rate of return, you are the one that will assume the discount rate to be used. I don't know where which course is going. You're just going off and on, and then distracting me. This last time I will admit you. So you are supposed to assume two discount rate that will produce two opposing NPV. Examiner will not give to you the cost of capital or the discount rate. It is your responsibility when you are calculating internal rate of return. You are the one that will assume the discount rate to be used. Therefore, let's start with 10%. So we assume 10%. If the 10% is positive, we'll increase it to 15% to get a negative NPV. But if 10% is negative, we reduce it to 5% in order to get a positive NPV. All right, so let's start from there. So we're assuming 10%. So I will then come here, 10%. So instead of me to create two different tables, I can divide this one into two. All right, let me reduce. Let me reduce this. Okay. Then let me reduce, change this one to DF. Discount factor at 10%. Okay. Then another discount factor at, I don't know yet. So let me reduce the space here. And this one too. Let me turn this one to present value, PV. So I need additional column here. So another PV. This should be the PV at 10%. Okay. All right then. Create additional row. This should be for Naira. Naira. So yes, we are starting from year 0. We are calculating NPV. So let's calculate the first NPV. So in year 0, you are going to have the current market value of the debenture. And according to the question, we are told that the market value of the debenture is 106 naira. So in year 0, you put it in brackets, 106. All right. So discount factor for year 0 is always 1. So 1 multiplied by 106. So it means that the present value at year 0 is equal to 106. All right. So I will then go back to the question. When is the investor going to exercise the rights? You are told that the debenture will be converted to equity shares in 4 years' time. So the exercise date is in 4 years' time. Therefore, this company is going to pay annual fixed interest from year 1 up to year 4. All right, the company will pay annual fixed interest from year 1 up to year 4. Okay, so I will then go back to the question. What is the interest rate the coupon rate given to us in the question is 10% convertible. So before I put it down, I need to check from the question if I'm given tax rates. Of course, looking at the question, we are given company tax rate of 40%. So if we are given company tax rate of 40%, then I cannot use 10 as my interest. So I need to go and calculate after tax interest. So I will come here working. I want to calculate post-tax. Post-tax interest. You can call it post-tax or after-tax interest. Okay. Let me push this one to the next page. All right. So to do this, the after-tax interest is computed as interest multiplied by 1 minus tax rates. Interest multiplied by 1 minus tax rates. Okay. So I will then go back to the question. What's the interest rate? Interest rate is 10%. Forget about the percentage like I mentioned. So just say 10 multiplied by 1 minus, the tax rate is 40%. So 40% is the same thing as 0.40. All right. Therefore, this will give us 6 naira.
6 naira, yes, sir.
All right. So that will give us 6 naira. I will then come here. My interest, this will be 6 naira, year 1 to 4. So I need to calculate annuity factor. Somebody should give me annuity factor of year 1 to 10. Sorry, year 1 to 4 at 10%. That should give you 3.17, right? Confirm. 3.170.
Yes, sir. 3.16170.
Yes, 3.169.
All right. So to then get the present value, that will be 6 multiplied by 3.17. So that will give us 19, rounding.
19,
This is
yes,
19.
sir.
So now in year 4, I need to, at the final year, this is the exercise date. I need to go and calculate the conversion value versus the redemption value. Any of the two that is higher is what I'm going to put here. But for now, I don't know. I need to go and do my working first. Therefore, I will then come here. Conversion value. Let's start with the redemption value. Or let's put it this way. The higher of then number 1. Well, let me just put a bullet point. Okay, the area of redemption value. What's the redemption value for this debenture? If they want to redeem this debenture, at what price? We are not told. We are not told. That means we are going to assume 100 naira. We are not told how it will be redeemed, whether it's at par, at premium, at a discount. So since you are not told, you are going to assume it will be redeemed at par. Therefore, this will be 100 naira. So the next thing you are going to do is to then calculate the conversion value. And like I said earlier, the conversion value is computed as number of shares that you want to convert to, then multiply by the share price. What's wrong with you? So in this case, according to the question, we are given 40 shares. Then multiply by, what's the market price? According to the question, market
3.50.
price is 3 naira 50 kobo. Okay, so multiply by 3.5. So this will give us 140 naira. So you then compare the two. So 140 naira and also 100 naira. So 140 is higher. Therefore, I will then come in and put value. That's all you need to do. It's as simple as that. So here will be 140. Then discount factor at 10% for year 4 is what? That will give up 0.683. All right.
Yes, sir.
So 0.683 multiplied by 140. What do you have?
$95.62.
95.62. That's 96. 96 plus 19 minus 106.
9.
9, positive 9. Okay,
Yes,
so
sir.
our NPV is positive 9. So we assume
It has to be lower.
10%. Promise mute. So we assume 10%, and that the 10% produce a positive NPV of 9. So to now get a negative NPV, we need to increase our discount rates. So we assume 10 and then 15%. Let's use 15%. So I will then come here 15%. Somebody should give me annuity factor of year 1 to 4 at 15%. Yeah. 2.855. Thank you. Okay. So here will be 2.855. Of course, this is equal to 1. Then you multiply with 106. That will give us 106. So discount factor for year 4 at 15%. What do you have? Okay. That's 0.572. You are correct. 0.572. So let's multiply to get the present value. 6 multiplied by 2.855.
17.13.
So that's 17. 140 multiplied by 0.572. That should be 80, right?
80.
Yes.
Yes.
So 97 minus 106. That will give us negative 9. All right, so that's negative 9. So we assume 10%. We got a positive NPV of 9. We increased to 15% discount rates, and we got a negative NPV of 9 as well. So at this point, we can then proceed to calculate the internal rate of return. Let me copy formula from our previous explanation. Okay. That's redeemable. Where is the formula before? Anyway, I have it somewhere. This is it. So we then go ahead and calculate the internal rate of return. Okay. So let me see. Yeah. This is KD. So that's the formula for calculating internal rate of return. All right. I can then come here to say that KD, cost of convertible debenture, will be calculated as lower discount rate. We assume 10%. 10% is lower than 15%. So 10 plus the NPV of the 10% is equal to 9. Let me just copy this. So here is 9 divided by 9 plus 9. All right, so that's it. All multiplied by 15% minus 10%. So our final answer, 9 divided by 18, that's 0.5, multiplied by 5, that's 2.5 plus 10, that's 12.5. So KD is equal to 12.5%. KD is approximately, let me use approximate. Okay, KD is approximately 13%. That's it. This is how to calculate cost of redeemable debt. The cost of convertible debenture of Singapore Limited is approximately 13%. That's it. This is how to calculate cost of convertible security. Whether it is preference, whether it's convertible preference share, convertible bond, convertible debenture, convertible loan note, whatever it is the same procedure. It's the same procedure you are supposed to follow. So if that is the case, at this point, we can then move to discussing weighted average cost of capital. Let's talk about weighted average cost of capital. Any question for me so far? Do you have any question for me? If not, let's move on. Okay. So remember when we started this topic, we said that to calculate traditional work, there are 4 steps that are supposed to carry out. So far, so good. We have completed the explanation on cost of equity, cost of preference share, and then also how to estimate cost of debt. The last step is to demonstrate how to calculate weighted average cost of capital. So calculating weighted average cost of capital, WACC. Okay, so how do you estimate WACC? How do you estimate WACC? What is WACC? Okay, so WACC represents the overall cost of capital for a firm, weighted according to the proportion of each source of finance in a company's total pool of capital. So far, like I said, we have calculated cost of equity, cost of preference share, cost of debt. So the average of all the 3 sources of long-term financing, is what is known as weighted average cost of capital. However, the cost of individual source of finance should be weighted. Okay, should be weighted according to the capital contributed by each source. All right. So that is the essence of WACC. Of course, the essence of why you are calculating WACC is for the purpose of like I mentioned the other time, to evaluate projects, majorly to evaluate projects or to measure performance, okay, or to determine the debt equity proportion. These are some of the reasons of the usefulness or significance of cost of capital. Okay, so let me put it down for you. WACC. This represents the overall cost of capital for a firm weighted according to the proportion or mix of capital, weighted according to proportion of each source of finance, weighted according to the proportion of each source of finance in a company total pool of capital or funds, in a company's total pool of capital or funds. Now, if you want to calculate your WACC, WACC can be calculated using the book value or market value to do the weighting. Remember, we said that the WACC represents the overall cost of capital for a firm, weighted. So when you want to do the weighting, you can either use the book value method or you use the market value method. All right. So let me just put it down for you. Let me do it this way. Methods of calculating WACC. Methods of calculating WACC. Number one, we can use market value method. Number two, you can use book value. Recently, there was a particular question where examiner was asking students that they should explain why market value is preferred over the book value. All right, it's a sub-requirement in that particular question. So what I'm about to say is what examiner is expected you to say. Okay, so let's explain each of them. Market value. What do you mean by market value? This represents the price determined by the market forces of demand and supply. This represents the price determined by the market forces of demand and supply. And it is the most acceptable price by the investors. Okay? It is the most acceptable price by the investors because it represents or it reflects or incorporates current information about market condition. Okay, it reflects current information about market condition. All right. And that's why market value is preferred over the book value. Okay. So how do you then estimate market value? How do you calculate market value? The formula below of market value can be calculated using the formula below. The market value of individual source of finance can be calculated using the formula below. So anytime you want to calculate WACC, examiner will not tell you, okay? Examiner will not tell you that you should use market value or book value. So it is implied in the question. So under this circumstance, at all time, you have to use the market value. Let me go put it down for you. The market value method should always be used to calculate WACC, except otherwise stated or required. Okay, anytime you want to compute WACC, you must use the market value to do the weighting because it's the most acceptable method. And then because of the fact that it reflects the current market information. All right. So anytime you want to calculate the WACC, so you need to go and first thing first, you need to go and calculate the market value. So I would then say calculating market value. So the first one is to calculate equity value. You want to calculate market value of equity, or you call it equity value. Equity value is denoted as E. How do you calculate equity value? All right. How do you calculate equity value? Depending on the information available. Equity value, the market value of equity is calculated as number of ordinary shares multiplied by the ex-dividend share price. Okay, ex-dividend share price. So that is the formula to calculate the market value of ordinary shares. All right. But if in the question you are not given number of shares, it is possible examiner may give to you share capital. Therefore, you are going to use the share capital, you are going to convert the share capital to number of shares. So in this case, I can also calculate, my equity value as, let me copy, I have, okay, this is it here. All right, so if in the question you are not given market, sorry, you are not given number of shares, then in that case, you can also calculate your number of shares by dividing the share capital as given to you, you divide it with the nominal value or nominal price. or par value. You can call it nominal price or par value. Okay. So that's that. You then multiply with ex-dividend share price. You can see here also, we're still using ex-dividend share price. Okay. Peace Palmer. Why now? You are writing on my screen. Stop it. Let me stop sharing. Okay, so examiner will surely tell you, the information you are given in the question will tell you whether you should use the first formula or the second one. So if you are given number of shares, just multiply number of shares with the ex-dividend share price. That will give you the market value of the equity. But if you are not given number of shares, certainly you are going to be given share capital. Therefore, share capital divided by the par value multiplied by ex-dividend share price. Also, you can see that we are still using the same ex-dividend share price. So what that simply means is that if you are told that dividend has not been paid, you need to go and convert it to ex-dividend share price. So before you can calculate your market value. So that is how to calculate the market value of equity. What about preference shares? All right, it's the same formula. So value of preference shares. All right, equal to the same formula that you have here. It's the same thing we are going to use. Okay, but in this case, you are referring to preference share. It's no more ordinary shares. So number of preference shares, number of preference, plus of spade, let me just shorten it. Number of preference shares multiplied by ex-dividend share price. All right, multiplied by ex-dividend share price. Or you can also say, if you are not given the number of preference share, you can also use this is denoted as P. All right, let me see, where can I shorten? Let me shorten this one too. Yes, Oluwatosin, talk to me.
All right. Please, we get to this S dividend. Something just struck my mind when we did that for debenture. The last question we solved said interest was just paid or something like that. Will that not
Yeah.
change our methodology or to confuse the student?
What did you repeat it?
I don't, I don't know which one. The last question we solved, it was
Yes.
stated that interest was just paid.
Yes.
Would that not change the approach or just to confuse the students?
No, it's
So
the
I'm looking
same.
at
So
S dividend. When we said S dividend and cum dividend, there is different.
yeah.
The approach should be different. So that's now just occurred to me that they mentioned that interest was just paid, so it will not change the approach, right? For the
So
debenture.
it's the same thing for the debenture if interest has not been paid. I mentioned in our last class. So if interest has not been paid, it means that it is cum int price. So you need to convert the cum int to X int price before you calculate your cost of redeemable debts. All right. So at all time you must do that
Okay.
adjustment, the same adjustment you have done for equity, preference share, and also that you just have to make that adjustment. The interest must have been paid before you calculate your cost of debt. Yeah,
Oh, okay. Thank you. Thanks, sir. Very clear.
you're welcome. So like I said, it's the same formula that you are going to use to calculate the value of the preference share. All right. So that is that. Then the last one is formula for calculating the market value of the debt. Okay, so the debt value, I'll call it debt value or market value of the debt, denoted as D, is computed as nominal value multiplied by X interest price. Okay, let me copy this. Multiply by X interest price divided by 100 naira per unit. X interest price divided by 100 naira. So, of course, depending on whether it will be redeemed at par, whether it is quoted at 100 naira or at 1,000 naira, whatever the information, examiner will always give you the direction that you should follow. All right. So these are the formulas that you can use to calculate the market value of individual source of finance as shown in the capital structure of the company. Okay, so that is that. Then the second one is book value. The second one is book value. All right. So how do you then calculate? What do you mean by book value? Then how do you use book value to estimate weighted average cost of capital? So let's discuss that as well. All right. So book value method. Let me put method here. All right. Book value method. The book value, also known as the par value, face value, or nominal value, it represents the value of the figures shown in the statement of financial position or balance sheets. This represents the figures. This represents the figures as shown in the balance sheets or statement of financial position as shown in the balance sheets. They are historical values. They are historical values. However, when calculating, before that, let me just put it. The book value does not, okay, let me just continue. However, when calculating WACC, using the book value method, ordinary share capital, and reserves. Ordinary share capital and reserve or reserves must be added together. To form the proportion of equity in the company total pool of capital. Or let me just, to form the proportion of equity capital structure or in the company total pool of funds. All right. So anytime you want to calculate WACC using the book value, all right, you have to add ordinary share capital and the reserve together. All right, so that will give you the mix of equity in the company's total pool of capital. All right, so for example, let's say, let's say you are given ordinary share capital. You are given ordinary shares, shares of 1,000 or 1,005, as the case may be. Let me leave 1,000. You're also given reserve of 500. You have preference share. You are given preference share of 800. Okay. You're also given debts in form of debenture. You have debts in the question. You are given debt of 700 for simplicity. So when you look at the total capital given in this, for these hypothetical figures, you see that the total capital is about 3,000. Okay, total is 3,000. So if I now want to calculate, my WACC, okay, using the book value, these are the book value. These are the value you have in the capital structure in the balance sheet. So if I now want to calculate my WACC using the book value method, I'm supposed to add ordinary share capital and reserves to form the proportion of equity. So in this case, equity value will then be equal to ordinary share capital plus the reserve. So this will be equal to 1,000 plus 500 plus 500, which is 1,005. So this will form the proportion of equity. All right. Of course, preference share will be equal to 800. Debts will be equal to 700. So the total value in this case, total value will then be equal to 3,000. So if I'm now calculating my WACC, which is KW, it will then be equal to, let me use this one. So if I'm now calculating my WACC, all right, so I want to use, since I'm using book value, so it will be the value of equity. In this case, equity will be equal to 1,500, then multiply by, divided by the total value of 3,000. That means proportion of equity is 50%. I will then multiply this with the cost of equity, multiply by, let's say, for example, we have cost of equity of 15%. So I will say multiply by 15%. This will give me the weights, the average cost of equity. I will then do the same thing for preference share. Do the same thing for preference share. Let's say you will have preference. Our preference share here in this hypothetical figure is 800. So this will be 800 divided by 3,000. Let's say cost of preference share as calculated is 12%. All right. Again, let's say we also have debts. We have debt capital. All right. And we are given debt capital of 10% for simplicity. Of course, the value of the debt is 700. So at the end of the day, of course, the average cost of equity plus average cost of preference share plus average cost of the debt is what will give us the weighted average cost of capital. That's why we are saying that weighted average cost of capital is the overall cost of funds weighted according to the proportion of each source of finance in a company's total pool of capital. So here we are using the book value to do the weighting. In the first one, which is market value, we are using market value to do the weighting of the WACC. All right. So this is what you are going to do. Book value is not common in most cases, especially at this level. But examiner, you can't predict. Examiner can ask you to use book value. So now you know. Okay. So finally, let me give you the formula to use to calculate the WACC. Weighted average cost of capital can be calculated using the formula below. Okay. So anytime you want to calculate WACC, it is computed as, let me see, let me use I'll use formula this, and then let me even start with the brackets. I'll disappear again. Are you sorry? Copy this. Okay. So if you want to calculate your WACC, you are going to calculate, you go ahead and determine equity value. It could be the market value or book value of equity, whatever it is. Then divided by equity plus preference share plus value of the debt. All right. This is capital letter. Then everything multiplied by cost of preference share. Okay, so this is the formula to get the weights of equity. You then repeat it depending on the information in the capital structure. All right. So let me just copy this. Repeat it for preference share. In this formula, we're assuming that we have all the long-term source of finance. Okay, so here will be value of preference share multiplied by cost of preference share. Okay, then plus value after tax, value of the debt, which is D, divided by total value, or multiplied by after tax cost of debt. Okay, 1 minus T. All right, you must adjust for tax. Of course, before you get to this point, you would have adjusted for your tax when you are calculating the cost of debt. Okay, so this is the formula for calculating WACC, where E equal to equity value. All right. Then P equal to value of preference share. Then D equal to debt value. Okay, you already know KE equal to cost of equity Then KP equal to cost of preference share. Then KD equal to cost of debt. Of course, T equal to after tax or post tax equal to post tax cost of debt. Sorry. Okay, let me post tax cost of debt. So this would be KD into 1 minus tax. Okay. All right, so that's the post-tax cost of debt. Of course, T equal to company tax rates. So that's that. This is how to estimate weighted average cost of capital. For those of you that have done financial management at skills level, you're already familiar with this. All right. So this is all the explanation as far as weighted average cost of capital is concerned. Of course, finally, let's talk about the underlying assumptions, okay? Particularly at this level, examiner can ask you assumptions of work. What are the underlying assumptions of work? The following are some of the underlying assumptions of work. What are they? Number one, projects are financed. Projects are financed. Projects are financed with the pool of capital, with available projects are financed from the available. Let me put it that way. From the available pool of capital. Okay. So the capital contributed by each source of the finance is what the company is going to use to finance the projects. All right. Then number two, the current debt equity proportion, the current debt equity proportion or capital mix will remain constant, will not change. Okay. All right. Then number three, this project size. The project size is small relative to the company size. Such that any change in the projects will not be significant, or any change in the project will be insignificant. Any change in the project will be insignificant. or immaterial. Okay. So these are some of them. Because of time, these are some of the underlying assumptions of WACC. All right. All the assumptions must be present before you can use WACC for the purpose of evaluation. Okay. So finally, let's have these short examples. This is not the kind of question you are going to meet on the day of your exam. This is just for explanation purpose, particularly to demonstrate how to calculate WACC using book value and also the market value. All right. So yes, let me see. Some of you have disappeared. That's okay. Yes, I need somebody to read this small question for us just to demonstrate, so that in our next class, we'll be solving the ideal questions. We'll be solving ideal questions. All right. So, yes, who is helping us? Felicia, are you still there?
Yes.
Promise. Okay, Felicia, go ahead.
What I can see is just the table. The upper part, I can't see it.
Okay,
Okay.
sorry.
The account of Austral PLC reviews the following capital structure. 1 naira ordinary share at 2
Leave
million
those
naira.
ones. Leave those ones.
Market value of the Abu share is as follows. Ordinary share 3.75x deep. Debenture stock 18 naira. Cost of equity 20%. Cost of debt 7.5 after tax. That's post tax. What is the weighted average cost of capital using book value and market value?
All right. So examiner is asking you to determine weighted average cost of capital, all right, using the book value and also the market value method. So I will then come here solution. Let me maintain the existing color. All right, solution. The name of the company is Ostra PLC. And the examiner is asking us, we're asked to calculate weighted average cost of capital using the book value as well as the market value. So let me adjust for this. All right, so I will then come here, calculating weighted average cost of capital, denoted as KW. So to do this, first thing first, I need to write down my formula. I will write down this formula. In the question, we don't have preference share, so you are going to remove the middle one. All right, so I will then come here. WACC is calculated as KW equal to equity value multiplied by cost of equity divided by total value plus debt value multiplied by after tax cost of debt, all divided by total value. So in this particular question, like I said, we don't have preference share. Therefore, you remove the middle one. We remove preference share from a letter. All right, so that's that. So it's as simple as this. Let me just copy. We're almost there. In the next 2 minutes, we'll be done. So I will then go back to the question. Examiner has asked us to use book value. I will then say using book value. All right. So using the book value, I will go to the balance sheet as given to us. The value of equity is value of ordinary share capital is 2 million. Remember, when you are using book value to calculate work, you are supposed to add ordinary share capital and reserve together. So you are going to add ordinary share capital plus reserve. Therefore, for equity to form the proportion of equity, we have 2 million plus 3 divided by total value. Total value of equity and debt in the capital structure is 6 million. Then multiply by cost of equity. Examiner has made life easy for us by giving us cost of equity to be 20%. In most cases, you are the one that will estimate the cost of equity. All right, so this is 20%. Then plus debt value. According to the information given, debt value is 1 million naira divided by total value. Total value is 6 million. Then multiply by after-tax cost of debt. According to the question, we are given after-tax cost of debt of 7.5%. So examiner is in love with you. So they're giving you straightforward information. Of course, it doesn't happen like that in most cases. You are the one that will sweat. From the first one to the last one, you sweat it out. Okay, so I can then say my work is equal to 5 divided by 6 multiplied by 20. Because of time, let's just calculate it straight forward. So 5 divided by 6, 5 divided by, 5 divided by 6 equal, then multiply by 20. That's 16.67. Here is 16.67% plus then 7.5 divided by 6. That should be 1.25.
1.25%.
1.25. So by the time you add the two together, what do you have?
17.92%.
17.92. So that's it. So you can then say work is approximately, this one is bigger, I think. Let me reduce, okay, 14. Yeah, so work is approximately 18%. Okay, so it's as simple as that. Approximately 18% using the book value. So do the same thing using the market value. All right, using the market value. Using market value. So in this case, we need to go and calculate the market value. We don't know yet. So we then go and do our workings. Workings, we want to calculate equity value. And we said that in the question, I need to go and check from the question, we are given share capital of 2 million. We don't have ordinary shares, so we are given share capital. So in this case, the formula I'm going to use to calculate my market value of preference share would then be this. This is the formula I will use. I will also need this one for that. Let me just copy the two. Let me copy the two together. Okay. This one can come down. So equity value is share capital divided by nominal price multiplied by X dividend share price. So I will then go back to the question. When you are using market value, you don't add ordinary share capital and reserve together. You don't do that. It is only when you are using the book value that you had it. So the nominal price is 1 naira per share. 1 naira. All right. Then ex-dividend share price as given to us in the question is 3 naira 75 kobo. Is it 3 naira 75? Let me confirm.
Yes, sir.
Yes, ex-dividend. So if dividend has not been paid, you have to convert it to ex-dividend share price. So what do you have here? 2 million shares multiplied by 3 naira 75 kobo. What do you have?
7.5.
7,500,000. Okay, so that's the market value of equity. Then you calculate market value of debt. Let me call this one equity value. All right. Get out. Okay, so for the debt value as well, do the same thing. You already know the formula. So debt value is nominal value. According to the question, the nominal value simply means the balance sheet value. So
Yes, sir.
the nominal value of the debenture is 1 million naira. Okay. Then multiply by X interest price. According to the question, the market price of the debenture is 18 naira. Okay, it's 18 naira. So we are not told whether the debenture interest has been paid or not. So where you are not told, you are not going to assume that the debenture interest has been paid. So if examiner wants you to make adjustments, you are going to be told that it is cum int price. All right, so here is 18 naira divided by 100 naira. So this will give us 800,000. Equal to 800,000. All right. So the total value then will become total value of equity, total value of equity plus debt will then be equal to 7.5 million plus 800,000. So that will give us 8,300,000. All right, so I can then go back to my calculation. So because I'm using market value method, right? So my numerator, which is the market value of equity, is 7.5 million. The total market value is 8.3 million. Cost of equity remained as 20%. The market value of the debenture is 800,000 over total market value of 7.5 of 8.3 million. Then multiply by after-tax cost of debt. So give it to me. What do you have? 7.5 divided by 8.3 multiplied by 20. What do you have?
18.072.
Pardon? 18.007.
Yes.
Then 800 divided by 8,300 multiplied by 7.5. What do you have?
0.7%.
0.7 what?
2, 2.
7.72, two decimal points. So this will then be equal to 18.79. 18.79%. All right, approximately WACC is 19%. Okay, WACC is 19%. So you can then say the work of Astra PLC, the work of Astra PLC is approximately 18% using the book value and 19% considering the market value method. Okay, that's it. It's as simple as that. This is how to calculate work. No matter how big is the question, that is the formula to calculate work. So like I said, this is where we are going to call it a day. By the grace of God, when next we are meeting, we are going to be discussing, we are going to be solving questions. We are done with relevant explanations of traditional work. Okay, so this is the conclusion of a traditional work concept. So in our next class, the kind of question you are going to meet on the day of your exam, we are going to be solving it. Okay, so let me know if you have any question for me. So that we can close the class and I can release you. Any question? Some of you have disappeared.
Yes, sir.
Yes, talk to me.
I said no question for me.
Okay. Yes, let me see. Abigail is still on. Abiodun, God's power. I have Raphael, Akinwale, and Shakira, Dekunle, Deleayo. Then I still have a faith. Accommodate. I have Fortune, Bemisola, I have Glory, I have Ibrahim, I have Idrisu, Ifi is still on, Jeremiah, Kende is on, Olaide, Olatubosun is also on, Oluwatosin, Oluwabukola, Oluwayemi, that's the Folusho. Promise is also on. Rabiat is still on. Sonia, Temitope, Toluwani, Paul, then Zoom user. Thank you, everyone, for waiting behind and then keeping me company. So by the grace of God, we shall continue next week, Tuesday, when we shall be having calculations. Thank you once again. See you next time by the grace of God. Good night, everyone.
Thank you,
Thank you,
sir.
sir.
Thank
You're welcome.